Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. After a week's hiatus, we're back this week with a big focus on the UK with our Chief UK Economist and Chief Global Economist, Ross Walker, to cover several angles of when it comes to the UK: politics, economy, monetary policy. Before I bring him in, I want to flag a few dynamic changes since we last spoke. Some of the biggest news has been the increasingly elevated nature of European inflation, which has raised expectation for not just higher policy rates from the ECB in the near term, but the market now pricing more than 125, getting close to 150 basis points in hikes by year end. ECB meeting, which was just released, the announcement was just before this podcast recording, shows that upward pressure in bond yields continuing. And part of it, in my opinion, is because the ECB has signaled the need for higher policy, has pre-announced policy rate increases for July and September, but is still holding off on actual policy rates. So the feeling that they could be further behind the curve by saying we need higher policy, but we're not doing it, has continued to help push 10-year bond yields higher. Now that push higher has gilts also pushing higher, although a lot of that in the past week when it comes to the UK fixed income market was related to the fiscal side and politics, which we'll get to. My point here is that leadership for higher global bond yields has shifted to Europe and the UK from the US. US 10-year yields have again broken 3%. But I think it's important to differentiate that US inflation's peaked and the Fed has actually started raising rates, while that is not the case in Europe. The pace of decline in the US is important when it comes to inflation. And I'll note that we're talking about this before the US CPI release this week. But this is different than in Europe, where, again, as I noted, inflation hasn't peaked. The ECB has not started raising rates, even though they have laid out a base case path. So not only should European yields take the lead here, but I would argue that US yields should also be a little bit more immune to the upside pressures compared to earlier in the year. There's also strong implications here for the currency markets. As we see more stability on the US rate side, not outright stability, but perhaps relative stability compared to Europe and UK. And as European UK rate expectations continue to rise, this should bring a more mixed environment for the dollar versus earlier in the year when stronger dollar was one-way trade because of all this US leadership. And this is what we've seen of late. Euro's trading back over 107, sterling's back over 125, and it's been more of a sideways, albeit choppy, move in the last several weeks. So speaking of sterling, Ross, there's a lot to cover this week. First, let's start with the economic side of things. You've raised your base rate forecast for the UK, one more for 22, but also for 23. Take us through your new call and what's the reasoning behind it?
So yes, essentially we now have an additional quarter point rise in 2022. So we see rate rises in both June and August this year. And we've also put in what was previously our risk case, 2 quarter point rises in the first half of next year. And the trigger for that was the additional fiscal stimulus unveiled by the Chancellor 2 weeks ago. It's sizable, it's about 0.5% of GDP. It's timely. These transfer payments essentially will begin next month and will come through in the remainder of the year. And it's also very targeted. It's skewed towards lower income households where firstly we thought the most acute stress would be felt in terms of the energy and cost of living shock, but also that section of the population is where you will get your most fiscal traction. There will be the highest marginal propensities to consume. So this fiscal stimulus should be quite powerful, and because it's coming at a time where obviously inflation is still running above target, exceeding expectations by a modest margin, it probably does put some upward pressure on monetary policy and puts a bit more onus on the BOE to raise bank rates.
All right, related to that, on the politics side, is Johnson going to survive, or and partly related to that, well, directly related to that, if he does survive, is he weakened to the point where they can't get anything done, or does he need to throw more fiscal stimulus in order to survive?
Well, I think just as we are in what feels like quite a different macroeconomic environment and monetary policy environment, the political landscape feels different as well. I think probably any previous prime minister in my lifetime who held a confidence vote and saw 41% of his own party voting that they had no confidence in that leader, that leader would have stepped down immediately or would be expected to step down imminently. With Boris Johnson, it's less clear. So he is clearly trying to cling on. Whether he can survive until the next election, I think, is very debatable. But the risk that he steps down in the next few months and we therefore enter a different political cycle potentially, an earlier election bringing forward some fiscal stimulus, I think that risk is probably diminishing versus prior to this confidence vote. So it's still noisy, it's still messy, it's uncertain, and although, I think probably the overall fiscal outlook is a looser one, and in the aftermath of the vote, there was a lot of noise about tax cuts being forthcoming, Johnson throwing some red meat to his base. I think the probability of an earlier election, one coming before the May 2024 deadline, is probably diminished. Nevertheless, we are going to see some. I think is almost inevitable. We will see some additional fiscal loosening, and so from a medium-term perspective, a bit more pressure on the BOE to offset that.
Okay, now how does this new Brexit legislation come into play? I mean, is this just an attempt to show strength and lead internally, or is it an external risk where investors and companies and leaders should be worried about?
It's a bit of both. I think part of it. I think one of the initial reaction in the currency market to these political events was that sterling rose, and there may have been some political risk premium being taken out. In other words, Johnson has had a warning shot fired across his bows. Maybe he just dials down the confrontation with the EU. The alternative possibility is that, as with the tax cut proposals or suggestions, he tries to appeal more to his base to shore up his position. And at least in terms of the early noise, that would seem to be the political direction of travel. Now, the key thing to remember with the legislation that the UK government is proposing in terms of reneging on parts of the settlement with the EU is that this could actually take some time, potentially up to a year is being talked about, for this to actually become law. So at the moment, it still feels like we're in the sort of gesture politics phase of this. So there won't be an immediate breach, it seems, of the EU treaty, but it's there bubbling away in the background. And I think, from a political perspective, a currency market perspective, this is not particularly helpful. So, and it certainly adds to this sense of confusion. And so, whilst there is a case that fundamentally the pound is oversold, the UK is not in a uniquely unfavourable macroeconomic position. The BOE the risk is they do deliver a little bit more tightening than certainly economists, if not markets, expected. Nevertheless, I think that the political developments are pushing a little bit against that. So it feels like we've added to uncertainty and potential volatility.
Yeah, and that's the last thing markets need, is to add to uncertainty and potential volatility right now. But all right, thanks, Ross. A lot going on there. As a reminder that you can never rule out political surprises from Westminster and 10 Downing, it seems. That's it for this week. Next week, in addition to the Bank of England, we have the June Fed, where we expect 50 basis points in hikes, but the real news for us is going to be around the forward guidance via the dots, and then Powell's tone, just about how he feels like the risks are shaping up around inflation. Again, note this is being recorded before the US CPI number, so that'll have a big influence on all of that. There's also a lot of UK activity data out, European inflation, Bank of Japan meeting, Chinese activity data. It's a very full week, so after a relatively light one this week, despite all the political and developments and the ECB. On the data front, we have a lot going on, so stay on your toes out there, and we'll talk to you all next week. Thank you very much. I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.